the distributee's tax consequences. And we're going to move on to the consequences to the other partners, the non-distributee, or to the partnership. We left off, let me pull this up. We left off on problem 3 on page 360. Let me pull that up. So this is a very simple fact pattern, and it's illustrating this section 732 D election, which is kind of like a mini 754 election, as we'll see. So we've got new partner here buying an interest, a 1/3 interest. And so let me pull this up. Let me so we can sort of take this from the top. So we have a 3-person partnership before a new partner comes in. So you've got A and B and C, and they each contribute 20 of cash. So they each have 20 of capital account and outside basis. And then they take the 60 of cash and they buy land for 60. And the partnership also generates an account receivable for services. And because the partnership's on the cash method, it's really like it doesn't exist. Okay, so that's the setup. The land goes up to 90, but there's no realization events, so that's unrealized appreciation. The receivables are worth 30, and again, that's not taken into account yet because the partnership's on the cash method. And then let's say that C sells her interest to new partner for 40. New partner is going to pay 40 because the land is worth 90, the receivable is worth 30. That's 120 of value. C's interest is 1/3, so a new partner will pay 40 for 1/3 of the partnership. So we start with C. C's consequences, C's amount realized is 40. C's outside basis is 20. C has 20 of gain. The partnership has a hot asset here. So under 751A, we hypothesize a sale of that hot asset for fair market value, which would be 30. 10 of that 30 of gain will be allocated to C. So 20 of this gain is ordinary income under 751A. And 10 of the gain is long-term capital gain, assuming C held their interest for more than a year. Okay, so that's C's tax consequence. We're not really asked for C, but just to set us up, and that makes perfect sense. There's 30 of built-in gain in each of the land and the receivable. The land's built-in gain is long-term capital gain. The receivables built-in gain is ordinary income, and so we're taxing C correctly. Okay, any questions on C? All right, now new partner comes in. And so new partner is going to step into the shoes of C as the capital account, but new partner's outside basis is now 40 under section 742, because that's what new partner is paying for it. The next question for new partners would be whether a 754 election is made. Because if it is, then we're going to get special basis adjustments for the land and the receivable. Let's assume there's no 754 election. And we'll also assume there's no 732D election, as we'll talk about, that's available upon the distribution of the receivables. So let's say the receivables are distributed to the partners, pro rata, 1/3 of the receivables to each of A, B, and N. So because we're distributing the receivables, when we distribute property, we have to book up the receivables to fair market value before we distribute. So we're going to book this up to 30, its fair market value, and allocate the resulting book gain to the partners. And they've agreed to share that gain 10, 10, and 10. Remember, that's 1.704-1B2, 4 little i's. I'm going off memory now. Let me see if I have my notes. Okay, so we book that up, and then we distribute the receivables. And we distribute the receivables. The capital accounts go down by the fair market value of the receivables. And each partner takes a carryover basis of 0 in the receivables under 732A1. So they'll each take those receivables with a fair market value of 10 and a basis of 0. And we reduce their outside basis by the basis they take in the receivables, which would here be 0 under section 733. So when we sum it all up, A and B are taxed correctly. Remember, they each had a 10 of built-in gain in the receivables and a 10 of built-in gain in the land. And they're going to take the receivables with the 10 of built-in gain. And by the way, character is going to be preserved because that receivable will be an ordinary asset under section 735 in A and B's hands. And they still have their 1/3 share of the appreciation of the land, which is still in the partnership. So A and B are taxed correctly, as you would expect. N is weirdly taxed here because N, again, remember, N is really buying 1/3 of the land for 30 and 1/3 of the receivables for 10. N's paid for the receivables with cash, after tax cash. So it's bizarre for N when the receivables are in his hands and those are collected or sold, he's going to have 10 of ordinary income. And that's, again, that phantom income to him. It's not real income. He bought in at 10. That's the 10, really, if you think about it, is the 10 of ordinary income tax to C. That was C's ordinary income. Now it's being taxed again to N. It really doesn't make any sense, but that's the result. Same thing if the land were sold. Let's just run this through. If the land were sold for fair market value, there would be 10 of gain allocated to each partner. And that's also phantom gain for N. The good news is that, okay, now we've got 90 of cash in the partnership. That's what we sold the land for. If we were to liquidate and distribute 30, 30, and 30, and we get a 20 of capital loss on liquidation. So it's our familiar problem that in an appreciated partnership without a 754 election, the buying partner is going to get phantom gain, phantom sort of early gain, potentially ordinary income, and offsetting, not perfectly offsetting capital loss upon liquidation of the interest. So that's N's problem. Two ways N can solve this problem here, at least with regard to the receivables. One would be to get the partnership to make a 754 election. If 754 election, then he's going to get an SBA of plus 10 in the receivables and plus 10 in the land. That SBA is going to then become his basis in the receivables when it gets distributed to him. And the SBA in the land is going to shelter that 10 of tax gain. But a 754 election, we know, has to be made by the partnership. It's permanent, effectively. And as we're going to see in a little bit, it also has implications with regard to 734. So another option would be section 732D, which we haven't looked at yet. So let's turn to that code section, 732D. So it says for purpose of A, B, and C, and these are all basis rules. What's the basis of distributed property? That's what 732 does. If a partner who acquired all or part of his interest by transfer, by sale, it could also be a death time transfer, with respect to which the election provided in section 54 is not in effect, and to whom a distribution of property is made with respect to the transferred interest within 2 years after such transfer. So there's a time limit here. Once you get to 2 years after the transfer, this election is no longer available. That partner may elect to treat as the adjusted basis of such property, that's the distributed property, the adjusted basis such property would have if the adjustment provided in 743B were in effect with respect to the partnership property. So what does this mean here? If the 754 election had been in effect, N would have a plus 10 SBA with respect to the receivables. So his personal basis with respect to receivables is 1/3 of 0 plus 10. So his basis in the receivables is would be 10, and so therefore on distribution within 2 years, he would take a 10 of basis in the receivables and the receivables distributed to him, which again is within 2 years, and he makes the election. So he takes a 10 of basis in the receivables, and then he reduces his outside basis by 10 under section 733. So now N has the receivables outside the partnership. They have a fair market value of 10, and now they have a basis of 10. So now when the receivables are collected or sold by N, N has no gain. So N would want to make this election. It's kind of a, again, sheltering what was going to be pretty quick ordinary income. Again, the receivables are going to be collected or factored. They call that factoring, sold, or they might become uncollectible. If it's uncollectible and you have a zero basis, then you get no deduction, no bad debt deduction. But if you have basis in the receivables and they go bad, then you get a deduction. And so there's hard for me to understand a reason why N would not want to make this election in this circumstance. And again, because it's personal to N, A and B don't have to agree. It doesn't have to be a partnership level election. It doesn't affect, there's no SBA in the land. The only way this could affect the land's basis would be if the land were distributed to N within 2 years of N acquiring her interest. So any questions on that? So again, in terms of like issue spotting, if you see a distribution of property to a buyer of a partnership interest, and there's no 754 election, and there is this 732D election that can be made by that partner that can give that partner a step up in basis in the distributed property. And again, if we sold the land, let's say the land is then sold later on, as we did before. Again, A, B, and C would each get allocated their 10 of gain for book and tax purposes. This is the difference. If there were a 754 election in effect, this would be sheltered as well. But there's no 754 election, so this is the phantom gain. So N would have phantom 10 of gain on the land sale. Then again, when we distribute the cash, which we now have 90 of cash, 30, 30, and 30, N would have a capital loss on liquidation of 10. So this is not as good for N as a 754 election, which would help him also on the land sale, but it's better than nothing. Okay, any questions on any of this? Now's a good time. Again, it was a good review. We got to review the consequences to a buying partner. I'm sorry, the selling partner, C, 751A. We did the consequences to the buying partner, which is N. And then we dealt with distribution of property.
And why can't 732D go to a land sale?
Because by its terms, it only applies when there's to a distribution of property within 2 years. So the land is not distributed, it's sold. So if it's sold within 2 years, that's not good. And it's a pretty limited circumstance. Again, it has to be you buy the interest, and then within 2 years, you receive a distribution of property, not cash. Cash has a basis equal to face, so that's never going to be an issue. But a distribution of property other than cash, then you have this opportunity to make the election. And this is actually, you can make the election or not on a property. If you get distributed multiple pieces of property within 2 years, you can make the election for one and not for the other. Okay, any other questions?
Well, but so if they distributed the land to them without selling it, then you can make the election?
So if instead of, if you change the fact pattern and instead they distributed the land within 2 years and the election were made with respect to the land, then N's basis in the 1/3 of the land would be 30, 20, 1/3 of the common basis plus the 10 SBA that would have been there at the 754 election. So yes, if the land were distributed within 2 years to N, or 1/3 of the land, then N would get, and N made the election, the 732D, and could make the 732D election with respect to the land. But I assumed the land were sold. Let's go back to the problem and see if there's anything else to talk about. So we did, if there's no election, we did, if there was an election, what's his outside basis after distribution? We did that, that's 30. Must the partnership approve? No. This is a different, a procedural difference. It's significant. With 732D, only the distributee partner has to make the election. With a 754 election, the partnership has to make the election. Again, that becomes important. If the distributee partner doesn't have control of the partnership, then that partner can't force the partnership to make a 754 election. Will the 730D election have any immediate effect on the basis of new parties' interest in the land remaining? No. No SBA in the land. It could affect the basis if the land were distributed in liquidation of the interest, and we'll leave that aside for now because we haven't talked about liquidating distribution. So don't worry don't worry about E at all. But the point there is really that there's nothing here. This is the same. And that's really the point of showing this, that 732D doesn't help N on the land sale in the same way that a 754 election would have helped N. Okay, any other questions on that problem? Okay, well, we're moving on. Now we're going to talk about sort of the other side of the equation, the non-distributee partners. What are their consequences? So let's take a look first at section 731. Turn to 731. Focus on A, this is the consequences to the distributee partner. We talked a little about 731B, which is that when a partnership distributes property to a partnership, no gain or loss is recognized under the general rule. We're going to see some exceptions to that shortly. The general rule is distributions of property by partnerships are not a recognition event for the partnership. The next question is going to be, is there any impact on the inside basis of partnership property when we have distributions? And we're going to see that absent an adjustment, we can get into situations where the inside basis and the outside basis aren't in balance. So this is like 743, and it's kind of confusing that 734 and 743, and the tax lawyers get really comfortable distinguishing between the two. But like 743A, the general rule with 734A is that there's no adjustment to the inside basis. We just live with the inside basis, outside basis disparity, unless there's a 754 election in effect. Or unless there is a substantial basis reduction. So the general rule is you don't adjust the inside basis on distributions of cash or property. The exception is if there's a 754 election or if there's a substantial basis reduction, which we're going to see is not applicable with respect to operating distributions. Okay, so that's 734A, just like 743A, we just kind of live with it. It's not conceptually pure. It's not really a perfect system. We shouldn't really have inside basis, outside basis disparities. They result in, as we've seen, phantom gain and phantom loss and potential unfair tax burdens and tax windfalls potentially, but it's simple. That's the beauty of 743A and 734A is it's just easy. 754 elections give the result in a more pure result, but they have added complexity, as we've seen with 743B and now as we see here. So 734B then says in the case of a distribution of property to a partner by a partnership with respect to which the election is in effect, then the partnership shall, and 734B1, we're going to increase the adjusted basis of partnership property, increase the inside basis. And here with 734B, these adjustments are made to the common basis. With 734B, in the context of purchases and sales, purchases of partnership interests, the 734B adjustments were special basis adjustments that were personal to the buying partner. Here, these adjustments are made to the common basis, so they go on the balance sheet. So we increase the adjusted basis of partnership property by A, the amount of any gain recognized to distributed partner with respect to such distribution under 731A1. Well, what's 731A1 gain? That's where the distributee partner receives cash in excess of that partner's outside basis. So if the distributee partner recognizes gain because he or she receives cash in excess of her outside basis, then that gain, that excess, is going to also increase the inside basis of partnership property.
Can I ask a question?
Yes.
When we're talking about the common basis, so I'm like confused. What's the difference between the partnership's common basis and then the inside basis and the tax? And the
Common basis is inside basis. So inside, I'm referring to
like what is that on that chart? What is that?
That's the inside basis, and that's also the common basis.
Okay, good.
Distinguishing that between the SBA, which again, you think it's not going to go on the balance sheet. What you would expect to see would be like footnotes or addendums or whatever that says, okay, in addition, N has this. But with the 734B, we're going to see the adjustments are going to be made on the balance sheet itself. So again, if we have gain, recognized distributee, and a 754 election, in effect, we're going to increase the inside basis, the common inside basis. And then in B, in the case of distributed property to which section 732A2 applies. So 732A2 is where, remember 732A1 is where we would give the distributed property the same basis in the distributee's hands as it was in the partnership's hands, the carryover basis from the partnership to the partner. 732A2 then says, however, if the partner's outside basis before the distribution is less than the partnership's basis in distributed property, then give that partner a basis in distributed property equal to the lower outside basis. We did that last class. Again, it's kind of hard to talk about in the abstract, so we'll come back to this. But if we end up with a cram down of the basis of the property, if the basis of the property goes down as it moves from the partnership to the partner because of the 732A2 limitation. Now 732B deals with liquidating distribution, so we'll bracket that off for now. But if we have the 732A2 limit come in, then the excess of the inside basis to the partnership before the distribution over the basis that the distributed property to the distributee, whatever that crammed down amount is, that also increases the inside basis of partnership property. So those are our increases. And again, we'll do a problem in a second. Now we have potential decreases, but these are not going to be applicable with respect to non-liquidating distributions because we have a decrease when the partnership, a distributee partner, recognizes a loss. Well, remember, in a non-liquidating distribution, there is no loss recognized by a distributee partner. In general, we're going to see that when you only have a loss when a distributee partner receives exclusively cash in a liquidating distribution. And if the cash is less than the partner's outside basis, then that excess is going to be a loss. And if we did have that, then we're going to reduce the inside basis of partnership property by the amount of that loss. And then in B, in the case of distributed property, which 732B applies, 732B applies where we have a liquidating distribution where you receive property in a liquidating distribution. So we're really focused here on B1 B1 with the increase because we're talking about operating distributions now. Okay, so we're increasing partnership property basis, inside basis. The next question is going to be, how do we allocate the basis increase, right? If we have more than one property, what do we do with allocating it? Section 755 is the rules for that, but that really kicks us into the regs under 755. So let's turn to those regulations really quickly. This is 1.755-1E. Let's turn to Reg 1.755-1E. 1.755-1E. I'm sorry, -1C. I can't read my own handwriting. -1C. So this is 1.755-1C, and it tells us how we allocate adjustments under 734B. By the way, this reg also tells you how to allocate adjustments under 743B, but we didn't really get into the nitty-gritty details of that. You can kind of intuit what the right answer is, which is what we've done when we did the special basis adjustments. It's a little bit unclear without these regs how you would make these basis adjustments under 734B. So it tells us. So it says where there is a distribution of partnership property resulting in an adjustment to the basis of undistributed property under 734B1B, that's where we distributed property and there was the 732A2 cap came into play. Then it says the adjustment must be allocated to the remaining partnership property of a character similar to the distributed property. Thus, when the partnership's adjusted basis distributed capital gain property, so we distribute capital gain property, which then triggers the 734B1 cap B adjustment, then we have to make the adjustments with respect to capital assets of the partnership. If the distributed property that triggers the adjustment is ordinary, then we have to make the adjustment with respect to ordinary assets held by the partnership. So that's one rule. The second rule here is in two little i's, where the distribution resulting in adjustment under 734B1 Cap A, that's where we had gain recognized distributed partner because the distributed partner received cash in excess of outside basis. When you have that happen, the adjustment is allocated only to capital gain property. So those are pretty straightforward rules. But then we have another problem, which is what if we have more than one capital gain property or more than one ordinary asset, and we have to apportion it between those assets. Well, in C2, one little I gives us a rule for how we allocate among properties in the same class. So those are our rules. And again, they're very abstract without a fact pattern. So we're going to turn to a fact pattern in a second. But any questions about any of this thus far? Okay, well, let's turn to the fact pattern. So this is on page 360. We have this ABC partnership, and I'm going to reconstruct it. Again, it's a very simple fact pattern. We could say A, B, and C each contribute 70,000 of cash to the partnership. The partnership then takes 90,000 and buys capital asset 1, takes 40,000, buys capital asset 2, takes 20,000, buys capital asset 3, and still has 60,000 of cash in the bank. Then capital asset 1 goes down in value to 60. Capital asset 2 goes up in value to 60. Capital asset number 3 goes up in value to 60. So they're all worth 60. What that means is we have a net appreciation of 30. And so each partnership interest is worth 80. Started out worth 70 and then up 10 on a net basis. So it's each worth 80. And then what's going to happen is we're going to have A gets distributed capital asset number 1 in an operating distribution. And that's going to be economically a partially liquidating distribution because A is sort of cashing out a big chunk of her interest. And so A is going to go from being a 1/3 partner before to being a 1/9 partner after. And B and C are going to go from being a 1/3 partner before each to being a 4/9 partner after. So the first question assumes there's no 754 election and says, okay, what are the consequences with respect to this distribution? So let's put this up on the board. So again, we've got A, B, and C. And I'm just going to put book capital accounts and outside basis. The tax capital accounts are going to be the same as the outside basis. Here we have no debt. But let's just put that up. And so again, they each contribute 70 of cash. And then we've got cash. Property number 1. It's book and tax basis. is 90. Again, we have unrealized depreciation, but we haven't yet had any consequence to book it yet. So it's still at 90. Property number 2 is booked at 40. Property number 3 is booked at 20. So that's our balance sheet. We're going to distribute property number 1 to C. Now, we have to book down property number 1. That's 1.704-1B2 formalized E. We have to book that down. So that's mandatory. And so when we book that down, because we're distributing, we got to book it down to fair market value. We allocate the resulting book loss as the partners have agreed to share it, 1/3 each. Now, any questions on that? Now, it's also permissible because this is a partially liquidating distribution. Again, I'm using that term economically and not technically. It's not a liquidating distribution because C remains a partner afterwards. But it's partially liquidating because C goes from being a 1/3 partner to being a 1/9 partner. That's one of the events which is which allows, or for which a book up is allowed. So we can take a look at that. This is going to be regulation. We're going to turn there 1.704-1B2 for little i's F. That's our book up, our revaluation rule. So let's turn there. -1B2 for little i's F. So revaluations of property and the permissible, that's our sort of global book up. And the list of situations where you can do a book up are listed in F5. So we saw before where you have a contribution of money or other property by a partner to a partnership. Or if we liquidate the partnership, institutionalized, or a distribution of money or other property by a partnership to a retiring or continuing partner as consideration for an interest in the partnership. So that's what's happening here. We have a distribution of property to C, who is a continuing partner, but but part of her interest is effectively being cashed out. So then going from 1/3, so 2/9 of C's interest is being given as consideration for the distribution. Because C is going from 3/9 down to 1/9. So this is a permissible book up event. And in fact, it's going to make sense to book it up just to keep things straight. So we're going to do, because we're allowed to, and we typically would, we're going to book up and book down. We're going to book up 2 and 3 as well. Not required, but allowed. And it is best practices in terms of keeping your book straight. So we book up 2 to fair market value. That's 20 of tax gain. So that's going to be allocated 6.7 to each. I'm sorry, not book down, book up. And then we're going to book up number 3 as well to its fair market value, which is 40 of gain. Just going to go 13.3. And these are now reverse 704C properties because we have a book tax difference that was created not by a contribution of property, but by a revaluation. So we booked everything up. And now, well, any questions on the booking up of 2 and 3 as well? So now we can now distribute property number 1. And under the capital account rules, we reduce C's capital account by the fair market value of property 1. And then we ask, okay, C is then going to take the property individually with a fair market value 60. What is C's basis in the property? Again, no gain is recognized by anybody. You don't have a distribution of cash. So there's no gain to C, no potential gain to C. What's C's outside basis? Well, under 732A1, C would take the carryover basis. C would take a basis of 90. That's the partnership's basis. But 732A2 comes in and says, nope, your basis in this property can't be greater than your outside basis, which is 70. So number 1's basis is crammed down from 90 to 70. And because C is only receiving 1 asset, we don't have to allocate the cram down. We don't have to worry about allocating the cram down among different properties like we did last class with 732C. So in that respect, it's pretty easy. And then finally, under 733, we reduce C's outside basis by the basis he takes in the property. By 70. And then, because there's no 754 election in effect, and there's no substantial basis reduction, in fact, we're going to see that it's an increase. So the substantial basis reduction isn't going to be applicable in operating distribution ever. Then we don't make any adjustments to the inside basis. And so we can sum everything together. And we end up with that's the way the books look. And our balance sheet balances, thank goodness. We've got number 1 is off the books. That's gone. It's now in C's hands. We've got 60 of cash, 60 of book value cash, 60 of book value in 2, and 60 in book value of 3. So that's 180 of book value. We've got 80 and 80 and 20. That's 180. So it balances. But our inside basis now is 120, 60, 40, and 20. And our outside basis is 140. So we've created this inside outside basis disparity. I mean, in a way, you think about it, what's happened is 20 of basis in number one just went bye-bye, right? It's just gone. As the property moves from the partnership to C, 20 of basis went away, and there was no offsetting increase in basis anywhere else. And so you're going to have this result. And this result is not good, because what ends up happening is this lower inside basis here, when these properties are sold, there's sort of too much gain in there. And that too much gain is then going to be taxed to the partners when these are sold. Again, that's phantom gain. That too much gain is phantom gain. And then when the partnership liquidates, there'll be a phantom loss. But due to time value of money and potentially character, here character is not much of a problem. Not a problem because these are capital assets. If these were ordinary, again, you'd have sort of phantom early ordinary income and phantom later capital loss. Okay, so but that's the answer to the first part of the problem. There's no 754 election in effect. Any questions there? Okay, well now let's assume there is a 754 election in effect. What's the change? Let's go back to the code. Let's go back to 734B. So again, think about a big fact is going to be, is a 754 election in effect? And there will likely be, well, I'll have a list of assumptions in an exam. They're going to say, except as otherwise stated, assume the following. And so it may say a 754 election is in effect. And then it's in effect unless the problem says there is no 754 election explicitly, right? Or it could say no elections are made. Assume no elections are made unless, again, explicitly stated. Then you'd have to see a 754 election language in the fact pattern itself. But my point here is just, that's a really critical fact that you need to keep aware of. So back to 734B. So now we have 754 election is in effect. So we got that. So then we increase, if we have any gain recognized to distributee partner under 731A1, we had no gain recognized by C because C did not receive cash in excess of outside basis. C did not receive any cash. So no increase under 734B1 cap A, but we do have an increase in 734B1 cap B because 732A2 applied. Again, that's what took the basis of the property from 90 in the partnership's hands to 70 in the partner's hands. The that we increased the adjusted basis of partnership property by the excess of the adjusted basis of the distributed property to the partnership, that's 90, over the basis of distributed property to the distributee, that's 70. So 90 over 70 is 20. So we increase the inside basis of partnership property by 20. The next question is going to be, well, how do we allocate the basis increase? 734C says go to 755. 755 itself doesn't tell you much. So you have to go back to that 755 reg, 1.755-1C. 1.755-1C. C1, one little I, where there's a distribution of partnership property resulting in an adjustment to the basis of undistributed property under 734B1 cap B. That's us. That's what just told us to increase it by 20. Then the adjustment must be allocated to remaining partnership property. So that's properties number 2 and 3. We never increase basis of cash. Cash always has basis of face. We don't increase or decrease basis of cash. So the adjustment must be made to the remaining partnership property as property number 2 or 3 of the same character. Well, luckily for us, 2 and 3 have the same character as property number 1. They're both capital assets. They're all capital assets. But now the problem is we have 2 of the same character. So how do we give that 20? Do we give it to 2? Do we give it to 3? Well, we go down to C2, allocations within class. C2, one little I. If there is an increase in basis to be allocated within a class, again, that's capital asset or ordinary asset, the increase must be allocated first to properties with unrealized appreciation in proportion to their respective amounts of unrealized appreciation, but not in excess of each partner's unrealized appreciation, and then any remaining amount allocated in proportion to their respective fair market values. So just another formula. And so how do we apply that here? Well, asset number 2 has a built-in gain of 20. $60 value, 40 basis, built-in gain of 20. Asset number 3 has a built-in gain of 40. Fair market value of 60, basis of 20. So there's a total of 60 built-in gain. 20 of the built-in gain is number 2, so 20/60ths of the built-in gain, 1/3 of the total built-in gain is in 2, and 2/3 into 3. So we have a total basis adjustment of 20 times 1/3, that's 6.7, goes to number 1. 20 of total basis adjustment times 2/3, 13.3, goes to number 2. So, and because 734B, we adjust the common basis, we just change the basis, and now basis number 1 is 46.7 instead of 40. Property number 2's basis is now 33.3 instead of 20. So that's our answer now, is that, again, if you were asked to construct the balance sheet after the distribution, that this is what it would look like. And we now have cured the inside basis, outside basis disparity. We now have 140 of inside basis, 60 plus 46.7 plus 33.3 is 140. Outside basis is 70 plus 70 plus 0. Okay, questions on the balance sheet or anything we've done?
Yeah, like stepping back, did you say that we could just assume the adjusted basis to begin with for the 3 assets was the book value, like the 90 and 90?
Well, this problem here, I wouldn't give this problem the same way in this balance sheet here, because it kind of doesn't. But yeah, I mean, these facts, you know, again, it's like A, B, and C each contributed 70 of cash. They took that 210 of cash and then they bought these assets over here for this amount. And then asset 1 went down in value, 2 and 3 went up in value.
All right.
So that's just, I'm sort of just taking you back to first principles here.
Thanks.
again, if I gave you this problem, I would say, okay, A, B, and C, contributed 70 cash each, and then that was used to buy these assets, and then these assets changed in value, and then asset one was distributed to A. Okay, so you wouldn't have to get implied stuff, but you should, once you get that background, you should be able to do A and B. Now, any other questions on A or B? So you should be able to do the technical stuff. C is getting at, it's a weird question, but it's getting at, even with all of this, this doesn't actually get to the right answer, the perfectly correct answer. And let's try to consider why. Again, it's not as important C, but the technical stuff is what you need to handle. I'll ask you, what the balance sheet looks like. But if you go back here, so if you think about it, before we had the distribution, A, B, and C, again, number one had a loss of 30, and 2 and 3 had a built-in gain of 60. So there was a net built-in gain of 30, and A, B, and C each had 10 of that. And if the partnership had sold all of its assets and liquidated, that would be the result, that they'd end up with net 10 of gain to each of them. So in theory, they should still have net 10 of gain built into these properties. Now, number one has a net built-in loss outside the partnership after the distribution. So one has 10 of loss outside, so C should have 20 of gain remaining. A and B should each have 10 of gain remaining within these assets. But if we hypothesize a sale, so let's go forward and let's say, okay, the partnership then sells property 2 and property number 3. So sell 2 and 3. What happens? So if we sell 2 and 3, there's going to be 40 of gain. There's 23 roughly of gain in 2. I'm sorry. Yeah, 13 of gain in 2 and 27 of gain in 3. So that's 40 of gain in these assets. And how is that gain going to be allocated? Recognize that's all reverse 704C gain because we're selling for 60. And so that's all set reverse 704C gain. So the 704C rules say, we haven't really dealt with 704C in this manner, but the idea would be, since they each got allocated the same amount, focusing here, they each got allocated the same amount of book up, they should each get allocated the same amount of the 704C gain. And so they each get allocated 13.3. So they each be taxed on 13.3. And that's where it's just doesn't make sense. Because A and B are sitting here saying, wait a second, I have a built-in gain of 10. How do I get 13.3? And C should be allocated 20 because he's got the built-in loss here. So he should be allocated built-in, the remaining gain of 20. So in theory, the right answer ought to be that, I'll put that in brackets, that the 40 of gain ought to be shared 20, 10, and 10. That's the conceptually right answer. The problem with that is that the rules don't seem to allow it. Since you allocated the book up 1/3, 1/3, 1/3, you got to share this reverse 704C gain, 1/3, 1/3, 1/3. And so, the frustrating thing is, all this complexity we just dealt with to sort of, fix the inside basis, outside basis disparity, it still is not intellectually satisfying. Now, again, what's going to happen is, since A's outside basis is going to be 83.3, when the cash ends up being distributed in liquidation, 80 to A, 80 to B, A and B will each have a 3.3 loss. And C is going to end up having when C gets allocated 20, it's distributed 20 in liquidation, C will have 6.7 of gain. So again, in the end, it reconciles. It's just the whole point of all this was to not have phantom gain and phantom loss, when in fact we do have this phantom gain. It's less than before for A and B, but it's still not, again, it's not conceptually pure. So you don't have to worry, again, as much about that. It's just the rules don't work perfectly well. Again, it's frustrating because you do a lot of work to try to fix these problems, and then they're kind of not fixed completely. But that's what that last problem is designed to indicate to you. But again, I wouldn't really get you to ask you anything beyond a problem like this, beyond just saying, okay, tell me what the balance sheet is after the distribution. So we kind of stop it after B. So again, in terms of the most important stuff we've covered today, it's A and B. And C is saying that really only A and B should get the benefit of the basis increase in B. But the rules don't work that way, unfortunately, at least from a conceptual matter. The basis is common, base adjustment is common, and the partners benefited from it, each 1/3, 1/3, 1/3, because of the 704C rules. That's how they got allocated the book up with respect to those properties. Okay, questions on that? So again, just let's step back. What did we do? Again, if you have a distribution of property or cash, then the distributed partner will have, again, operating distribution, so the distributee remains a partner. Then the rules are the distributee recognizes gain if the distributee receives cash in excess of outside basis. If the distributee partner receives property, then the basis of that property is determined under 732. Generally a carryover basis, but we have that 732A2 cap. And then we have correlative adjustments to the outside basis under section 733. Then if we have no 754 election in effect, then we don't increase the inside basis. We just stop. And we may have inside basis, outside basis disparity. Again, that would be a situation where your books balance, of course they have to, but your tax books don't balance. If, on the other hand, there is a 754 election, then if the distributee partner recognizes gain because he or she's received cash in excess of outside basis, or if the property's basis is reduced when it moves from the partnership's hands to the partner's hands by virtue of 732A2, then we're going to increase the inside basis of the partnership property. And then the rules for allocating that increase are governed by the 755 reg we just talked about. If the increase is because the distributee received cash in excess of outside basis, then it gets allocated to capital assets. If the distributed properties whose basis was reduced as it moved from the partnership to the partner was a capital asset, then the basis adjustment goes to capital assets of the partnership. If it was an ordinary asset, it goes to ordinary assets of the partnership. If you have more than one asset within the class that's going to receive the basis increase, then the rules in 755-1C2 apply to tell you how it gets divided among multiple assets in the same class. One question I sometimes get is, what if you have to increase with respect to capital assets, but the partnership has no capital assets? So let's say you distributed your last capital asset that then triggered the 734B adjustment. Well, then the rules say your basis step up, the increase under 734B, is held in abeyance until the partnership acquires a capital asset. Same thing with ordinary. So if you have that situation where you don't have any, I won't test you on that nuance. Again, in my test, the problems are going to look a lot like the problems we did, right? This stuff is hard enough. I don't have to test you on novel stuff. But anyway, for those that are curious, if you have no asset of the type you're supposed to increase the basis of, then you sort of wait and see until you acquire an asset of the character of which you're supposed to increase the basis. Okay. All right. Well, we're going to move on. So those are the general rules. As we know with tax, there's always exceptions. And we're going to cover the exceptions to these general rules, start covering them next class. So we have a couple classes on important exceptions to these rules. Okay, any questions? All right, well, have a good weekend. I'll see everybody on Monday. Bye-bye.